Hello and welcome to today's training. I'm Carla Brown, EA, and I'm the owner of Brown Tax and Accounting LLC. So today we have Rob Bolduc, EA, joining us. Rob has over 31 years of tax and accounting experience. He is an enrolled agent and a certified tax coach, and he is a very trusted and respected member of our team here at Brown Tax and Accounting. The title of today's training is The Physician's Guide to Cash Balance Plans, How to Structure Multi-Million Dollar Retirement Plans that let you deduct six figures a year legally. Rob, I'll turn it over to you.
Awesome. Thank you, Carla. Appreciate the introduction and welcome everybody. Good afternoon to wherever you may be viewing this from. And we got a great topic today. It's one that is powerful tax strategy and best of all, it's legal and it's relatively easy to implement. So without further ado, let's get into today's discussion and topic about cash balance plans. And we will get right to identifying what is the problem that many of you as high-income physicians are struggling with. And that is to build wealth and sustain it. So even at your high income levels, most physicians we find their annual tax liability is exceeding their annual savings rate. So after you account for taxes, much of what remains goes toward maintaining either your lifestyle or your medical practice expenses, leaving limited capital compounding for long-term wealth. Traditional retirement vehicles that you may already be familiar with, IRAs most notably, were never designed for high earners. Contribution limits effectively penalize success by restricting how much can be sheltered and invested tax efficiently. So the key isn't necessarily to go out and earn more. It's to restructure how your income is flowing so more of it works for you instead of the IRS. So that's the problem. Now here's the opportunity. The retirement structure that lets physicians deduct six figures a year legally. For years, hospitals, large corporations have used advanced retirement structures to fund multi-million dollar executive pensions. Today, that same IRS-approved framework, which we refer to in today's topic as a cash balance plan, can be implemented inside a private medical practice just like yours. It enables physicians to redirect part of their annual profits into an IRS-qualified plan, creating a current year tax deduction while building long-term wealth. So in practical terms, it's how independent physicians can create their own pension system, one that they own, one that they control, and most importantly, one that you benefit from. The result is a strategy that's both financially sophisticated, fully compliant, built to help you accelerate wealth without adding complexity to your practice. So why high-income physicians outgrow traditional retirement accounts? Let's talk about that for a moment. Contribution limits for these traditional retirement accounts are modest relative to your income as a physician. For instance, $23,000 for 401k employee deferrals and $7,000 for IRAs. These plans were built for employees, not high-earning business owners like yourselves who need greater flexibility and greater scalability. So even with employer contributions, most physicians still can't shelter more than about $69,000 per year through these plans. And once you hit these caps, every additional dollar is taxed, often at 37% or slightly more when you combine the federal tax bracket with your state tax bracket. So for physicians that are generating six-figure profits in their practice, these limits make it almost impossible to save at a pace that matches your earning power. So how does every extra $100,000 that you earn cost you an extra $35,000 in taxes? Pretty simple. Marginal tax brackets for high-income physicians like yourselves escalate quickly. Each additional $100,000 that you earn can trigger more than $35,000 in taxes, eroding your returns on time and your effort. This creates what we refer to as a tax drag effect, the invisible barrier, if you will, preventing income from translating into higher net worth. Physicians often describe it as being penalized for success, and you should not be penalized for the great success that you're all having. So what is the real cost of waiting? Taxes paid versus wealth compounded. So for every year, many physicians forfeit anywhere from $100,000 to $300,000 in potential tax deductions simply by not using advanced retirement structures. Over a 10-year period, that's $1 to $3 million unnecessarily paid to the IRS. money that could have been compounding in your own retirement plan instead. So redirecting 100 to 300 per year from taxes into your own plan can compound to 1.3 to 3.8 million in just 10 years and 3 to 10 million over a 20-year period at a conservative 5% annual return. All of this funded with pre-tax dollars that would have otherwise gone to the IRS. So inaction doesn't just cost you this year's taxes, it costs you the growth of those savings for the rest of your career. So what is this IRS approved strategy that lets you deduct 6 figures a year? Well, we touched upon it right at the outset. It's a cash balance pension plan. So what is a cash balance plan? Let's talk about it briefly. A cash balance plan is a specialized IRS qualified defined benefit plan designed for business owners and high income professionals who want to save well beyond 401k limits. It allows 6-figure annual contributions, typically 100,000 to 300,000 or more, depending on your age and your income, all fully deductible to the medical practice. These contributions reduce current taxable income while funding a retirement account that grows tax deferred year after year. In retirement, distributions are generally taxed at a lower effective rate, allowing physicians to keep more of what they've earned. So in short, what is a cash balance plan? It's a structured, compliant way to transform excess practice profits into long-term compounding wealth. How does a cash balance plan work? We'll put this in as plain of English as we possibly can when we're dealing with tax and tax terminology. But in your practice, not you personally, but your practice, your medical practice, makes contributions to the plan. Those contributions fully tax deductible to your business. The funds go into a professionally managed investment account in your name where they grow tax deferred each year. And because this is a defined benefit plan, your contribution amount is calculated by an actuary based on your age, your income, and your retirement timeline, meaning older physicians can contribute and deduct substantially more each year than, let's say, a younger physician. In essence, it allows you to convert active income into a tax-deductible, predictable, wealth-building vehicle that you fully control. Each participant in a cash balance plan, so you and any eligible staff, has an individual cash balance account that grows annually based on 2 key components: contributions, and these again are made by your medical practice, and interest credits. And this is a fixed or variable annual return, typically in the 4 to 6% range, that is set up by the plan. So let's look at a case study to see how this works in action in practice. How one physician shifted 1.4 million from taxes into wealth in just 5 years. So what was the profile of this client? This profile was a 52-year-old orthopedic surgeon. She was earning $850,000 annually from her private medical practice. But what was her challenge? Probably the same challenge that you're facing right now. Despite this strong income, she was paying nearly $300,000 a year in taxes and had already maxed out her 401k contributions. So what is the solution? Well, we established a cash balance plan customized to her income, her age, and retirement goals. The action part of this was the medical practice contributed $280,000 per year into her cash balance plan. Again, all fully tax deductible to the business. And what is the immediate impact of this to her? Her annual tax bill dropped by roughly $100,000, redirecting that money into her own retirement account instead of the IRS. That is powerful, and that is a win-win, and it's just awesome. All right, so what is the 5-year outcome on this case study for our doctor here? Well, we shifted $1.4 million from taxation into her personal plan over a 5-year period. That balance grew to approximately $1.55 million at a conservative 5% annual rate of return, all compounding tax deferred. These funds now form the foundation of her multi-million-dollar retirement strategy, backed by actuarial funding and IRS oversight. So what's the big picture key takeaway here? It's the same income We didn't ask her to go out and earn more money. It's the same income. It's just a different structure. By redirecting how her profits flow, she converted unavoidable tax payments into long-term compounding wealth without changing her workload or her lifestyle. So that's how a cash balance plan works. But let's talk about briefly, when do these plans make sense and when do they not make sense? So these plans are really best suited for physicians who are earning $300,000 or more annually with steady profits and the ability to contribute at least $100,000 per year. They're not ideal for an early stage or fast changing practices where cash flow may fluctuate greatly from year to year. These plans do require annual contributions and actuarial certification to keep the defined benefit properly funded. These plans also must pass IRS non-discrimination and participation testing each year to ensure fairness for owners and eligible staff. But when designed and administered correctly, these plans are fully compliant under ERISA and IRS qualified plan rules. So, how do high-earning physicians combine plans to keep more of what they earn? Here's something that's incredibly important and very powerful. A cash balance plan works best when we pair it, or if you will, if we marry it to a 401k or profit sharing plan. And yes, you can do that. The 401k allows employee level deferrals, flexible, smaller contributions that can vary from year to year. The cash balance plan comes alongside, adds large fixed employer contributions, providing scale and predictability. So together, these plans can allow total annual deductions exceeding $350,000 to $400,000, depending again on your income, your age, and how the plan is ultimately designed. But together, these plans create a layered structure that maximizes both flexibility and tax efficiency. So, what is the key to building wealth? And that key for us here in this presentation isn't earning more, it's just better structure. So most physicians, like yourself, you don't have an income problem, you have a structure problem. And taxes are often the single largest controllable expense. Yet, most practice owners still operate in a way that maximizes what they owe to the government instead of what they get to keep. By strategically using a cash balance plan in complementary retirement structures, high earners like yourself, you can legally redirect six figures each year from taxes into your very own wealth building plan. The difference between a good income and lasting wealth is not how hard you work, it is how efficiently your income is managed and how it's allocated. So now that we've discussed kind of the problem, we've talked about the opportunity, we've discussed the mechanics of a cash balance plan and how we compare it with a 401k plan and all that wonderful stuff, how we're going to redirect income, etc. Let's talk about the roadmap as far as how you get there. And this is the design, the implementation of your custom cash balance plan. So the first thing we do, there's 4 components here on this roadmap. The first one is an assessment. We start here by reviewing your income, your entity structure, and your retirement goals to determine if a cash balance plan makes sense. They don't always make sense, but when they do, they're just so powerful. So we assess all this. Does it make sense? And if the answer is yes, we estimate your potential annual tax savings. That's step number 1. Step number 2 is we get into the plan design. We work with our actuarial partners. We create a custom contribution model based on your age, your income, and your staff profile, and show exactly how much you can contribute and deduct. The third part of this roadmap is implementation. We coordinate the plan setup. We have compliance filings and trust account creation. We ensure that your plan is IRS qualified and ERISA compliant before the end of the calendar year. And the last step is the funding and the growth. This is where you fund your plan through your practice. You redirect your pre-tax profits into your retirement vehicle. And from there, these funds compound tax deferred under professional investment management. So that concludes my part of the presentation. If you want to find out how much you can save and how fast you can build multi-million-dollar retirement wealth, I encourage you, don't hesitate, book a complimentary tax strategy analysis session today with our team here at Brown Tax. And we would love to meet with you and discuss your tax planning needs and your pain points with taxes and how you can implement a cash balance plan paired with a 401k into your practice today. Carla?
Thank you, Rob, for such a great presentation. This is such a powerful tax planning strategy for high income medical professionals. So it's something that we're very excited to be able to help our clients with. And if you want more information on how a cash balance plan might work for you, you can book a call with us and we would be happy to discuss this strategy with you. Thank you, everyone, for joining in. We'll see you next week.
Thank you.
Thanks, Rob.
Yep.